Hello, my name's Alan Foom, and today I'm going to talk about value destruction by oil and gas companies. So things don't always go right. So here's an example of share of market capitalization of two companies, BP in red, ExxonMobil in blue. In 1990, they were both roughly the same market capitalization. You can see now how much greater ExxonMobil has become rather than relative to BP. And this is a picture of the Kashagan oil field in Kazakhstan. Again, largest discovery in the last 30 years, but the development has been plagued with a lot of problems, and that has led to a lot less value creation than had been anticipated, although still quite a bit of value creation. I was peripherally involved in that about 30 years, nearly 30 years ago now. So value destructions. Now, oil and gas companies have generally created billions in value for their shareholders. They've been overall pretty good investment, good dividend payers, etc. But this is not always the case because some companies have destroyed value in various ways. Some through operational failure, and that includes HSSE failures. Some through bad strategies, some through poor judgment and assumptions, poor project execution, or poor acquisitions. Now, if you avoid these pitfalls, things might get a little bit better for you. And this video is inspired by this post by Eddie Ong. Eddie is somebody who posts a lot on LinkedIn. He's a retired geologist. He lives in America, and he looked at value destruction in various geographical ways. So please check his post out on LinkedIn. I'm going to talk more about the why rather than the what, but Eddie gives a pretty good overview of the what. So, nod to Lev Tolstoy. Все успешные нефтяные компании одинаковые. Каждая неудачная нефтяная компания неудачная по-своему. All successful oil and gas companies are alike. Every unsuccessful oil company is unsuccessful in its own way. Anna Karenina, paraphrase. So this is a picture of Lev Nikolaevich Tolstoy in Yasna Polyana. It's a place near Tula, just south of Moscow. That was his home. And here's a diagram by Milkov and Vidi, published in 2019, looking at the different factors that work. So you've got processes, doing things the right way, people, getting your people right, getting property, getting into the right places, and you also need a bit of luck. I do a video on basin screening, and that's diagram and explain all the factors behind it in that video. Also factors within cognitive biases. Now, cognitive biases play a big role because we're all human. And the biggest bias here is overconfidence. Illusion of knowledge, availability, confirmation, information, motivations, perception blindness, status quo, etc. And you need to try to work around those biases to see where things can go wrong and to head them off at the pass. So causes of value destruction. The biggest cause is arrogance, that we know best. And a lot of oil companies, particularly major oil companies, are guilty of that. You know, you're very bright people, and perhaps you think you're brighter than you really are. Complacency, everything will be all right on the night. A good news culture. You know, only positive news gets fed up to the boss. Anything that's a problem is either brushed under the carpet, or we try to spodge it or solve it locally. We don't want to tell the boss bad news because we got a hippo. Highest paid person's opinion. I first heard of that from Matthew Syed, a British sports writer, but it wasn't him that invented it. It's quite a good thing. So a single person dominates an organization. Now, when that person is a great person, that's really, really good. However, when they're not, you've got a real problem. Bad project discipline, project acquisitions, appalling cost control, taking the wrong lessons from analogs. So this worked in Egypt, it's going to work in Mexico. Diversification into areas of limited knowledge, and the Dunning-Kruger event, where you think you know more than you really do. Misunderstanding of risk. Now, risk management is a key part of our jobs, but if it's a risk of something you don't understand, there's a problem there. And overestimating reserves, both internally and occasionally in terms of value statements in your annual reports. So, value destruction, choosing the wrong strategy and sticking with it when you've got contrary evidence. So diversification to unknown areas which you don't understand, new countries, new businesses, unconventionals, new energies where you have limited knowledge and you don't bring in people who do. Poor acquisitions into new areas, you know, when you overpay for stuff. Rapid unfocused expansion when you just want to grow without understanding where and why. Strategies that are based on ideology rather than objective analysis. And alternatively, you haven't got a clear plan at all. You just got competing strategies with all the different parts of the company working against each other, and God knows where you're going to end up. So again, choose the right strategy, and if you chose the wrong strategy, fix it. For project execution, now here's a book by Professor Ben Flyberg, How Big Things Get Done, and oil and gas is sort of not really doing that great. Average cost overruns 25-35%, and 20% of projects have got serious problems. Okay, maybe not quite as bad as IT or nuclear power plants, but we really need to do better, as many industrial sectors do. And in the UKCS, United Kingdom Continental Shelf, average project is 35% over budget, and only 25% project coming on time. Now, this is a mature area where you know the rocks, you know the engineering, you know the fluids. You do that, but we still don't. Price assumptions hedging areas. Now, oil companies use a series of price decks in the economic decision making. So generally, you would tend to have, let's say, $60 mid case, $40 low case, $100 high case, for example. But if you have over optimistic assumptions, that could be deadly for project value. So, for example, if your mid price deck is 60, but the real price is 40, well, kind of not that great. So is your break-even price greater than your realized oil price? You're in a bad place. Other issue there is slightly different, which is hedging. So this is when people sell oil and gas ahead of time to futures traders. So for example, let's say you will sell your production at $55. Now, if the oil price is $40, well, the hedgee has taken the loss and you've done okay. But if the oil price is $75, well, the hedgee's made all the profit and you haven't. And mistakes in hedging can lead to significant revenue loss during higher price periods, but does protect you during lower price periods. Failure to replace reserves. So purposeful oil companies convert hydrocarbon reserves into cash by producing them or selling the reserves to others. So hydrocarbon reserves are the main asset of an oil company, but this would decline as they're produced unless you replace them. There's three basic ways of replacing them. First is exploration. You go out, find new stuff, create new projects, add value that way. Or you upgrade existing fields through infill projects or uplifting known reserves because you've got more data suggesting that you do. Or you buy reserves by M&A. And all of those have pitfalls. And some companies have been less than stellar at replacing their reserves. Now, some of them might do it with strategy. Now, BP had a situation where they were wanting to run down their reserves effectively and move into new energies. That might have something to do with their oil price, with their share price. But some companies just aren't very good at it. And if you're consistently bad at it, you've got a problem. Poor exploration performance. Now, exploration is a risky business. There are no guarantees in this business. And that's something a lot of people go a bit, Frontier exploration, about 10% of wells find hydrocarbons. In mature basins, still some risk, but a lot of risk. 35 to 40% of wells will find commercial hydrocarbons, which means 60 to 65% of wells don't. And even unconventional hydrocarbons, for example, shale, still have some risk. And some companies are better at it than others. Some companies have done it consistently well. E&I has done it consistently well. Tullow had done it consistently well, although they had problems turning that into actual value. Company I used to work for, BG Group, did it very well until we were taken over by Shell. Others, less so. And they can waste a lot of money finding nothing of note. For example, KN Energy did quite a lot of frontier exploration in Greenland, where they found nothing. And they did it at very high equities as well, which is not really a good idea. And there's a video from my colleagues at Trove, again, excellent YouTube channel, please follow them. And they look at the Mukluk well in Alaska, most expensive dry hole in the world. Now, geologically, kind of would have made sense to look at it, but lost quite a bit of value. So please look at also at Eddie Ong's post where he talks about a lot of these things in a lot more detail. Overbidding in M&A through bad acquisitions. Again, easy way to lose a lot of money. In a seller's market, sellers would demand a premium. And in a bidding war, somebody will eventually overpay. There's limited time for evaluation, and there's asymmetry information. Although everything you need to know will be in the data room, some buyers may well miss vital details. Ambitious executives can drive deals beyond sensible levels. And if you're diversifying into new areas where you don't really understand, that's where you can get really stung. But you may get bargains and distressed asset sales, or if you've got smart acquisition people. But it's rare. You tend to mostly overbid. Misjudgments of geopolitical risk. So geopolitics is another area we look at. Political fiscal, regulatory, and legal. So fiscal, here's an example, UK tax rates for oil companies. So they're going up from something actually quite reasonable to something like 75-80% tax, where you can no longer make a profit. You can no longer make a sustainable business. Intergovernmental relations sanctions, for example, if you had invested in Russia prior to 2022, well, that's gone. Human rights, social reputation, armed conflict, both internal and between states. Again, something to worry about. And we need to understand that when we make our decisions. The original debt management. Capital budgets in oil and gas are vast. Wells cost tens of millions, up to 100 million plus for deep water PhD. A mega project cost over $1 billion. Now, the scale is something that many ordinary people just cannot understand. It really is huge. And even major companies, even your ExxonMobils, your Shells, may need to borrow from capital markets to finance really, really big projects because they can't do that out of cash flow. Small independents may need debt to finance exploration. So startups go into an area, but they have debt to start off with. And cost overruns may require more financing. And projects take longer than expected. You may need to borrow more money to do that. You're vulnerable to interest rates and market sentiment, pretty much like any other business, to be honest. And your vulnerability to production being below price, or prices being below projected. So if your income stream, it might be less than what you predicted. So managing debt, managing your finances is vital. Well, that's true for any other business, but for oil, the numbers are even bigger. Poor community relations. Now, again, we operate amongst communities. Even if you're offshore in the UKCS, you operate amongst fishermen, you operate amongst the military, etc. If you operate onshore, you're living literally drilling in someone's front yard. So getting on with them in a reasonable way might kind of be a good idea. And bad community relations can disrupt operations significantly. And bad community relations can negatively impact your company's relations with host governments, NGOs, investors, etc. So getting this right is very important. Operational failure. Keeping your production going in a safe way is obviously essential for revenue. If you have continual shutdowns, you get less revenue. And that could be through bad plant design, insufficient maintenance, poor staff training, poor staff supervision. A lot of things can go wrong. It's a complex business. Things can and do go wrong. So Murphy's Law applies. You've got complex relations with your contractors, your suppliers, etc., having things to go. One particularly bad thing there is called the TFA tragedies, which is touch FA, where a production manager has to deliver results and doesn't want to do maintenance, and that leads to problems further on down the line. And then the really big one, bad HSSE performance. Now, we hazardous industry, we take safety very seriously because people get killed, and they shouldn't. Got safety tools, safety culture. We made big strides in safety improvements since I've been in the industry. Still not there yet. Bad things can and do happen, and some companies are better than others. If you want to really judge a company, look at their safety reputation. That's doing well. They generally do everything else well. Single catastrophe obviously does a lot of damage. Apart from the people getting killed, it can be catastrophic for everything else. Small safety violations will have a cumulative negative effect. Longer term, it's a question of will there be demand? Now, this is a controversial topic, and you've got a wide variety of different views. So here's a chart of different oil demand projections. So you look at BP, IEA, EIA from America, IEA based in Paris, and Shell. So these are different scenarios. So you could be a situation where you have less than half of what you're producing now, roughly half of what you're producing now, or something similar to you're producing now, or maybe even more. So you've got to try to plan for that. Now, in terms of immediate value, that doesn't make much of a difference because most companies have a roughly 10-year proven reserve life. So this is looking beyond that because that's when your resources get converted into reserves. So there's a small risk of high cost assets being stranded. Major companies have been around for 100 years. They plan to be around for even longer than that. But how do you plan for this long-term future? So European companies are diversifying into new energies. American companies are sticking mostly to hydrocarbons. Okay, that's a bit of a simplification, but it's something you need to look for when you're looking for the future. So you look at advantage hydrocarbons. Again, trying to get the politics right, the cost right, the community relations right, environmental right, investment profile right, scalability right, fiscal terms right, and do it all safely. Who said running an oil company is easy? It isn't. So summary value destruction. If you're an oil company which to avoid destroying value, you need great HSSE performance, the right strategy, it's flexible cope with the change of world, managing your finances, your debt, cash flow, getting your project execution right, getting your business right, manage political risk, community relations, growing your people and systems, manage executive egos. Not easy, is it? So thank you very much. Please like, please subscribe, I'll see you